Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. One of the things I love about the markets is the reaction. Markets react and discount things very quickly, just like the way they are discounting rate cuts by the US Fed from May 24. The reaction, dollar much weaker, strong rally in gold, and good amounts of buying in treasuries. Adding to that is the famous investor Bill Ackman commenting that the Fed will cut rates sooner than what the market is pricing in. So lots of moving parts as of now, but I hope broadly you got the theme. JK, if the Fed would cut rates, it would probably be back on the. It would probably be because of a very severe economic slowdown. Given the current data, do you see US heading there, or is this just an overreaction?
Good morning, Swaraj. Yes, I think there is no straightforward answer for that because the data that we have been seeing from US have been quite mixed. And there are sectors where economy is still doing well. There are sectors where it is showing slowdown, particularly in the job, and also inflation is coming down. But as most Fed members are trying to push it down to the market, inflation is still above the target, and they are not ready to say that it's peaked out. Inflation has peaked out. So in that scenario, whatever the market may be assuming or discounting, like they are discounting a rate cut as early as May 2024, Fed is unlikely to act, yes, unless you see a sharp slowdown in the economy, which is not evident now. Now you will have one more evidence today when GDP data for Q3 second estimate is published, and Reuters consensus shows it's going to be at 5%, and last estimate showed it at 4.9%. So with that kind of number, even though it is a backward-looking data, they may not yet be ready for acting as per what market has been expecting. I think they would like to see more evidence of economic slowdown. And at least in the past history of last 10, 15 years, where I've been watching the market closely, the rate cuts do happen only when there is a sharp deflationary tendency, or if there is a crisis. So these two things are yet to be observed. So that, I hope I have answered your question. But coming back to the market yesterday, we have seen further sharp falls in the dollar overnight, and also the yields, continuing the trend of the recent past. The fall has been across the board in the dollar, and it stands out against the euro, GBP, and yen, which remain actually structurally under-owned currencies. That's why they actually look exaggerated, but they are not actually. If you look at the historical levels, they are still at very low levels. The trend has also intensified in the last few days as we have started to see some improved economic picture in these countries, including China and Europe, while data from US continue to be mixed, as I said earlier. Yesterday, we saw fresh falls in US yields, which helped push the dollar further down, breaking euro 1.10, GBP 1.27, and Japanese yen at 147, which was a previous low seen last month, while gold has made quick stride towards the all-time high of 2070. Now, giving impetus to yesterday's fall in yields and the dollar was a statement from one of the Fed governors, Mr. Waller, who said that he was increasingly confident that the current level of central bank's policy rate was sufficiently restrictive, and that if inflation keeps falling for several more months, Fed could start lowering interest rates or normalizing policy. And this is the first time that we have heard such a statement from a Fed member, but it did contrast again with other members' statements who have been pushing against market expectation, more particularly, Michelle Bowman, who continued to say that market expectation are way ahead and not really matching with that of Fed. The yield on 2-year paper fell a whopping 15 basis points, 10-year by 8 basis points, and 30-year by 4 basis points. And the Fed Watch tool continues to show 70% probability of a rate cut in May by at least 0.25%. As I said, we have a crucial GDP data tonight, which is expected to show 5% growth in Q3 following 4.9% that was estimated. If the data does confirm this number, as estimated by the market, we could see a sharp correction to the move in yields in the dollar that we have seen over the last few days. In fact, the stock did not add much to their gains despite such large moves in the yields. Particularly Nasdaq, which is more sensitive to the lower rate, just added 0.29%. And in Asia, the markets are really not moving anywhere. And let me also make this point that when currencies and yields move in Asian time, which does not have much of liquidity, they tend to be kind of a terminal move, or it is just to trigger some levels, and it does bounce back very strongly later. Let's wait and watch how it happens in the European and the US session ahead. On yesterday's data side, US house price index showed further growth in the September quarter, reflecting a 2.1% rise from the second quarter of 2023. And in fact, we have been reporting the slowdown in housing activity demand, which should be pinned down to the prices, have remained restrictive. In fact, data shows that housing affordability in the US is at multi-decade low, even as the price index is at multi-decade highs. We also had the Conference Board's consumer confidence data that showed index rising to 102 in November, as against downwardly revised 99.1 in October, which with the present situation remaining steady and expectations rising to 77.8 from 72.7. Yes, we also had the Chinese central bank governor giving a bid assessment of the economy, saying it will meet its 5% expansion target. And we have been seeing China economy showing some signs of improvement, while they are continuously on announcing some measure or the other to support the economy, and particularly the ailing real estate sector. Oil had a climb yesterday with some sort of consensus being rumored among the OPEC members for cutting the output. The outcome will be known tomorrow when they will be meeting online. Now come to rupee. If there is a price for a non-volatile but still an officially unpegged currency, rupee will win it hands down. World over, we have seen currencies depreciate or rally strongly in the last few months. In fact, we have seen both the moves, but it hardly had any impact on the rupee, with no one sure when will that change. While advocates of free market price discovery hate it, central bank and most corporates seem to be happy. But the risk of such a situation is a developing complacency among corporate, who run the risk when something out of the ordinary occurs, and it always happens in the market with varying time gaps. Notwithstanding, we retain some positive bias for the rupee, looking at various negative factors having reversed and the flows looking positive now. Looking for a trigger or a signal from the central bank that they are prepared to let the market have some say. Till then, 83.25 and 83.40 should cover it. A host of global events this week and the state election results over the weekend can challenge the engineered stability for the rupee. Thank you. Have a good day.
Thank you, JK. And now the important data that markets would be looking forward to is the US GDP data for the third quarter, third quarter second estimate, and it is the Reuters poll is showing it to come somewhere around 5%. So that's an important data point, and rather a strong number given considering what the market is pricing in. So I mean that's something markets would look forward to. And the other themes which are going on is the economic picture from China and Europe seeming a little better. But if we talk about the market reaction, the yields from the US fell quite sharply. And Chinese central bank governor made a comment that it will be meeting its 5% target given the number of stimulus and support being provided for the ailing sectors. For rupee, nothing much to write home about, not any major movement, but definitely there is a positive bias building in, considering all the global negative factors reversing as well as flows making a comeback. We'll keep tracking this story. That's it from us today. Thanks for listening, and tune in tomorrow for the latest in the financial markets.